the two factors are related. The first factor is the incentive compensation of these large bank managers. That issue is discussed in another Leeds video on the Leeds website. Today we will talk about the second factor that contributed to the banks engaging in these very high risk investments that have led to this economic catastrophe in our country. What we have in mind is the amount of the bank that is funded by equity and the amount of the bank that is funded by debt. In general, if a company is funded more with equity and less with debt, it tends to be a safer company. The debt ratio of these banks was in the 3% to 5% range around October 2008. Now, some analysts would argue that the bank's equity capital was actually close to zero because these banks were essentially bankrupt. They had to go to the US Treasury, i.e. the US taxpayers, to bail them out. Hence, their equity had a value close to zero. Hence, all of their bank was being funded by debt. So, how much equity is used to fund the average US corporation? That number is closer to 53%. So the average US company is funded more than half with equity. Let's look at some recommendations regarding how much equity a large bank should have. Basel III, just very recently on June 25th of this year, came up with a recommendation that large banks, both in the US and internationally, should have equity capital in the 8% to 9.5% range. And even then they said that these banks can take up to 2019 to get there. I would submit to you that Basel III, learned as they are and thoughtful as they are, have completely missed the boat on this one. I think that large banks ought to have significantly more equity than what Basel III is recommending. In fact, in a paper I wrote with a colleague, Brian Bolton, last year, July of 2010, we argued that large banks should have significantly more equity. We suggested a number around 25% of the bank should be funded with equity. A few months after we came out with our recommendation, several economists at Stanford University came up with a very similar recommendation. They argued that large banks should have equity in the 20% to 30% range. One of the typical fallacies that the industry has is they argue that if their bank is financed more with equity, then the bank's funding cost will go up. Now, this argument is completely incorrect. Let's look at the funding cost of a corporation. That corporation could be a bank, it could be an information technology company, it could be an industrial company. It doesn't matter. The funding cost of a corporation basically is a weighted average of the funding cost of its debt, or the cost of debt and the cost of equity. What the industry is arguing that if we fund banks more with equity, then the equity ratio essentially goes up, and hence if the equity ratio goes up, all else constant, the funding cost of the bank will go up. The reason why this logic is incorrect is because as the bank is funded with more equity, the equity becomes safer. As the equity becomes safer, the cost of equity goes down. So the equity ratio goes up, the cost of equity goes down, and two Nobel Prize winners, Morton Miller and Franco Modigliani, have shown that these two things exactly offset any increase in the funding cost of the corporation. So the mistake that industry practitioners and Basel III and other allies of theirs are making is a very fundamental mistake in corporate finance, is to argue that as a company is financed with additional equity, since equity is a more costly source of financing, that the funding cost of the company will go up. That logic is completely incorrect, because as a company is financed with additional equity, the cost of equity of that company goes down, and it goes down by just enough to offset the increasing amount of equity that is used to finance that company. And that same logic applies exactly for banks. So that's the first fallacy. Another fallacy that is related to the first one has to do with the return on equity. The argument is that as a bank is funded with more and more equity, the return on equity, often referred to in the industry and the media as ROE, goes down. Well, that argument is entirely correct. As the bank is funded with additional equity, the equity becomes less risky, and indeed the return on equity, or ROE, has to go down. Currently, banks are financed with roughly between 3% of the bank capital to 5% of the bank's capital comes from equity. Basel III is recommending a number between 8% and 9.5%. We are recommending bank equity several times more than what Basel III is recommending. The effect of this would be that banks will not undertake risky investments that essentially are value destroying,